Multi-asset portfolios offer the ability to invest in a variety of asset classes and deliver on the client objective by providing a smoother journey along the way. However, as we know, we live in a volatile and uncertain world. Joining me today to unpack some of the issues facing multi-asset portfolio investors are Co-CIO of PSG Asset Management, Gilchrist, and Fund Manager, Dirk Jooste. So, to kick us off, John, if we reflect on the recent experience in multi-asset portfolios, in 2022, global bonds and equities went into retreat at the same time, and we saw losses in the 60-40 portfolio. At the time, this led to a variety of headlines questioning the continued existence of these funds and whether they still had a role to play. So fast forward to 2023, and we've recently seen more volatility in US bond markets. And so a question that comes to the fore for many investors would be, are we going to see a repeat of the 2022 experience?
Thanks very much, RG. So as most people will be aware, the 60-40 portfolio is a simple benchmark used globally for lower risk or risk-conscious investors. And it comprises, as the name suggests, 60% in equities and 40% in bonds. And that 60% in equities is there to drive the capital returns, and then the bonds are there for income as well as risk mitigation. And data going back to 1950 from JP Morgan, for example, shows just what a great combination this has been. To put that in greater context, over essentially the last 50 years, every time that equities have been down, and the JP Morgan analysis focuses specifically on the US, every time US equities have been down, US bonds have actually delivered positive returns, offsetting that risk and creating a smoother ride. So this has become a benchmark for global multi-asset investors. As you mentioned, in 2022, we had bond yields rise significantly in the US and big losses coming through on bond portfolios. To put that in context, the S&P was down 20% in 2022. The bond portfolio was down 13%. So it actually didn't give you that mitigating and that risk mitigation that you would like to see. This year, we've seen those bonds move. The 10-year bond went from 1.5% through to 3.9% in 2022. This year, it's actually blown all the way out to 5%. And so losses are sitting at about 7%. But obviously, that's all in the past. And what people are looking at now is to say at 5%, is this a great opportunity? We believe actually there is still caution is warranted in this space. And there are four main reasons for that. The first is that we believe inflation is going to be higher than a lot of the market assumes. The market's still assuming 2% inflation. We're very concerned about the US fiscal situation. We're also not very comfortable with the US debt structure. And finally, if you have a look at the incremental buyers, it's questionable who's going to be buying the significant amount of issuance of bonds that is required. And so from a global perspective, that 60-40 portfolio, it's had a tough 2022, it's had a tough start to 2023. We don't think it's necessarily out of the woods yet. Turning to the local multi-asset portfolios, we actually don't like using strategic asset allocation. And what happened in 2022 to the 60-40 portfolio is an exact example why. If you've got bonds in your portfolio as a risk mitigator and they're very, very expensive, they don't perform that role anymore. And that's why we at PSG didn't have treasuries in our portfolios. A lot of people knee-jerk from a strategic asset allocation perspective will have those bonds in their portfolio, and it hurt their performance. It's also interesting just to note, if you compare that 60-40 global portfolio with the South African, for example, Dirk and I are managers on the PSG Stable Fund, which is in the low equity multi-asset space. If you have a look at that space going back to 2001, and that's as far back as we can get data on it, there's never been a calendar year where the average in the low equity multi-asset portfolio, where the average has actually been negative. It's been a phenomenal example of multi-asset used to smooth out the ride. Now, we acknowledge that's in the low equity space, so less than the 60-40 portfolio, and we acknowledge that it is in rands. But it's interesting to note just how well that category's performed.
So bringing the conversation closer to home, Dirk, given that we have risks in our local bond market as well, how do you combine the factors that we see at play locally when constructing portfolios for local investors?
Yes, so looking at the local fixed income market, it is important not to trivialize the risks that we do face as South Africans. But as always, with these situations, there's more nuance than typically appreciated. And it's quite important not to jump to black and white conclusions. South Africa, we do have quite a lot of anti-fragile features embedded in our market, and I'll just maybe highlight a couple. We have a very deep capital and savings market. So that means we're very well funded from an internal perspective. And then also looking at National Treasury, the average term of debt is quite long. So that also gives us quite a lot of time and also provides quite a lot of resilience. And then thirdly, we also have a reserve bank that is very, very credible and currently also acting as a prudent actor within the markets. Just looking at risk in South Africa, my sense is that fundamental risk will likely manifest more in episodes of elevated inflation as opposed to this notion of an all fall down kind of scenario. In turn, the Reserve Bank is running with very high real yields on the repo rate, and this is reflected in the money market side of the fixed income spectrum as well. Which means they're quite attractive and you are insulated against some of the fundamental risks that we are facing. Then this is also reflected in the South African government bond nominal bond market. On top of the high real yields, there's also quite an excessive country-specific risk premium embedded in that market. Again, that insulates investors from the fundamental risks of inflation and specific to the country. And then lastly, we also have very high real yields on offer in the inflation bond market. That's a segment of the market that is immune to inflation risk, so we find that very, very attractive. And combining those three asset classes in a multi-asset portfolio, we think caters for quite a various range of different outcomes. And investors can expect some very good outcomes over the short to medium term from South African fixed income assets.
One of the advantages of multi-asset portfolios is that they target real returns for investors. But when you target real returns, you have to include equities in order to get there over the longer term. So how do you weigh up those factors? And John, maybe you can take the lead on this one in terms of looking at that, managing that volatility and getting the longer term returns that you need to deliver.
Yes, so exactly what you said. When you have a look, and once again, I'll use the low equity multi-asset space as an example, the general objective there is probably real returns of 3% or even more. And remember, that category is limited to 40% equities. But actually, to get those sort of returns over the long term, you probably need 30 all the way up to 40% equity exposure in order to achieve that. And then the secondary objective within that category is to manage the risk. As you mentioned, the volatility, make sure that the client journey is appropriate. And that's a challenge. That's a really, really tough mandate to get right. So the only way that you can do it is, firstly, if I delve into the equities themselves, you're going to have a decent slug of equities, as I mentioned. You have to look at those equities really carefully in terms of how much diversification do they bring to the portfolio. Now, we are not benchmark investors, and that actually gives us a great opportunity to construct portfolios, equity portfolios, that are optimized in terms of the risk and return. We can make sure that those portfolios are appropriate for the mandate that we're managing. What's also important is a lot of people just use quantitative measures, backward-looking quantitative measures in order to address the risk. We do look at those quantitative measures, but we also look at the fundamentals. What is driving the earnings of those shares and how does that blend together? And then we also have a common sense overlay, which is really important. Look forward and understand, even though they might have behaved in a certain way in the past, how are the shares likely to behave relative to each other going forward? That's on the equity side of things. Obviously, we have the opportunity to use multi-asset, as the name suggests. So we're able to use a lot of the fixed income instruments that Dirk mentioned. At the moment, they're offering really attractive real yields. And the blend of that obviously mitigates the risks, especially if they're appropriately priced, as opposed to the 60-40 portfolio and what happened on US bonds last year. We also, what we're able to do is use NCDs. Dirk referred to those with very attractive real yields. We've got 16% of the portfolio in there. And then finally, bring it all together, we also make use of put options, just making sure that the risks are appropriately controlled. We're getting very good opportunities from our buy list signals, bottom up, but we are aware that from an overall perspective, there are risks out there.
So It's great to hear how you approach risk within the portfolio. But for many investors, the question is, with all this macro uncertainty that's out there, should they be worried? Dirk, what are your thoughts on this topic?
Yes, so it's maybe important just to say up front, this is nothing new. The markets will always move through periods of perceived high risk, and then in turn the market can get quite complacent at times and perceive there's no risks out there. We don't find it a fruitful endeavor to try and time this. We rather would use these times of elevated uncertainty to position our clients for the longer term. And that would be our message to our clients as well, to stay the course, to have a longer term perspective, and then just to ensure that you're well diversified. Make sure you're well diversified across asset classes, across geographies, and then just finally also guard against not overpaying for exposures within your portfolio.
Now, at PSG Asset Management, the view is often that uncertainty brings with it opportunities. And currently, when you look at the market, what do you see? Are there opportunities out there?
Yes, we actually are finding some very good opportunities. It is quite a rich environment for investors like ourselves that shop away from where there's acute competition for securities like the big indices. A cornerstone of our process is to have a careful consideration of the supply side dynamics of industries and sectors. And we are actually finding very good opportunities in more the real world sectors. They've been quite starved of capital and investment over the last decade. And this is quite in contrast to what we're seeing in the mega caps and the large cap companies in the tech sector as well. They typically dominate global indices at the moment, where there's been a lot of investment flowing in and a lot of extra supply putting into those sectors. So the sectors we find attractive, we can maybe highlight the energy sector, the materials sector, and then also global financials screen is very attractive from that point of view. As John alluded to, we have a view that inflation would probably be higher looking forward relative to the last decade. And companies with good supply side dynamics will typically have better pricing power and better prospects for earnings growth in a high inflation environment. That said, these opportunities at this point in time tend to be a bit more in the cyclical areas of the market. So we're just supplementing those positions with defensive areas, like we think it makes sense to have some gold exposure, just considering the imprudence of the fiscal dynamic of very developed world countries out there. We find global brewing companies very attractive, so they bring a nice staple sector defensiveness to the portfolio. And then South Africa is also very attractive in terms of an investment destination. Also from a supply side, there's very little investment going into our economy. So competition is less and the prospects look good. And we do like, maybe as something to highlight, the SA mid-cap sector is very, very attractive. Industries like tourism and infrastructure, also very little competition and very little investment going into those sectors. We've already touched on fixed income as being very, very attractive. And as John touched on as well, just overall risk balance by use of puts as well.
It's been a fascinating chat. Thank you so much. I'm sure we could carry on much longer, but sadly our time's run out. Thank you so much for joining me today.
Thanks, Audrey.